I think we're as close to our mandates as we've been in a very long time. And as I said last week, I do think that a rate increase at the March meeting is on the table for discussion. And the reason I think that is that the economy has behaved pretty much as we expected. In the meantime, the balance of risks, which has been to the downside in recent years, has really shifted to being even and perhaps lifted to the upside because of the possibility and indeed likelihood of some fiscal action. So you put all that together, and I think the case for a rate increase in March has come together. And I do think it's on the table for discussion.
There's two questions out there for the market. One is when that next rate hike comes. And sometime in that March to June period, I mean, already we're at 75% of the probabilities for March. But another is how many? Are you, even if you went early in March, would you still think 3 seems about right this year, or should we start thinking about a 4th rate hike this year?
You know, it all does depend on the path of the economy, and no one is particularly successful at predicting the economy more than a few months out. But I wrote down 3 rate increases in the September Summary of Economic Projections. That still feels about right to me. That's a gradual path by any historic measure, and it does feel to me that's about right. But it is really going to depend on what the economy does. It could be higher, it could be lower.
I know we get into a series of hypotheticals here, but it is important for the market to know about your $4 trillion balance sheet. If you complete those 3 rate hikes, do you foresee possibly at the end of that or sometime during that reducing the size of the balance sheet?
So the way I look at it is the interest rate, changing interest rates is the principal tool by which we affect financial market conditions, and that is our monetary policy tool. And I would like to use that tool. The balance sheet tool was deployed when we were at the zero lower bound during the height of the crisis and thereafter, and that's for extraordinary circumstances. So I'd really like to see us get well above zero, well into the normalization process before we start shrinking the balance sheet, because shrinking the balance sheet is a way of removing accommodation. So I'd like to be well away from that, and I would say that's going to take a little bit of time in my thinking. And then when we do go to shrinking the balance sheet, we can do it in a very predictable, almost automatic way.
Does that seem like it's a task for this year, reducing the balance sheet?
We're just going into a series of discussions about that, and I'm gonna keep an open mind for my discussions with my colleagues. But that's how I've been thinking about it.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.